let me get straight into it, guys. Rather than reviewing the highlights in terms of the agenda, I wanted to just re-go through some of these just for some emphasis, because these are really the framework of what we've tried to put together in the next few slides. And it's particularly around some of the ways we're starting to view the business, and particularly around having been through the transition of a build fibre infrastructure and some other areas of products and services. Can we get this into a really simplistic framework that people can understand, and more importantly, really value going forward? And there's some key points that you probably haven't seen in the past. And if I come on slide point one, which does go back to the back end of the presentation, which is the founder and the founding team's sort of vision that we really need to build an infrastructure in Asia Pac that is essentially the next generation fiber-based infrastructure, because this vision that we're going to see masses of uplift in connectivity, both in terms of cloud, data center infrastructure, OTT content, was always part of the fundamental thematic of the business. Fast forward 4 years, we're at the place now where we now have the various tools and assets and capabilities to really build on that vision and monetize it. So I position myself in the very lucky position of being the guy that's completed or been part of the completion phase, but really picking up the phase to operate. And I suppose the way I look at it is, if you can't look at me and the team in the eye and say, well, if we invested $256 million of capital in the fiber infrastructure, are you the guy that thinks that can monetize it and sell it? That's my role over the next few years. The other interesting thing that we've tried to emphasize here, and it was on a trip with Bevan and John and I recently to the US, where we're kind of just, I don't think people realize that this network is brand new. It's kind of 2 years at the worst case of some of the oldest assets over a lifestyle of the asset, which is 20 years plus. And think of that in the ways that traditional capital investment structures take place. Unfortunately, to a certain extent, we've been measured into short-term capital structures, short-term returns, but this network and asset is going to be around for a really, really long time. And we make the analogy later in the presentation of the new network and the old network. Well, these old networks that are managing telco-grade assets and mobile and telephony, they've been around for 100 years. Some of Telstra's copper is still 100 years old, and it's still generating 65% EBITDA. And guess what? That's had a lot of capital invested in it. The other thing is that we wanted to be very clear that whilst the underlying focus of the monetization and the really healthier returns of the future of the business comes from the on-net fiber, we have these platforms capability that we've been investing in, and partly through acquisition and partly through organic investment, which actually sit on top of this network and really start us to help create value. Creates value in 2 or 3 ways. Number one, it dives us deep into customer domains, both in terms of verticals and in terms of physicals. And secondly, anybody who follows customer stickiness, if you want to call it that customer retention, is the deeper you're embedded into a customer, the more likely he's going to spend more with you and the more likely he's going to stay. And in old telco terms, and probably same in financial terms, 2.2 products per customer almost means zero churn. Too hard to leave, got too much to lose, etc., etc. So that's part of the platform conversation. We've seen some of the financial statements there where we see we have a net book asset of $1.37 per share, and we've got 346 net assets post the 50.7 impairment. I'll cover the impairment as I come back through the slide, but really part of that was around the February decision that some of the cloud managed services portfolio, which was part of an acquisition, was non-core to the strategy. It was distracting to the strategy. It was actually value destructive to the strategy. It has some customers that we want and some customer relationships that we're going to maintain through the carriage side of it. But the products that we're selling them, the capability, and indeed the whole support infrastructure around it was non-core. So we made that change. And therefore, even in a year of change and a year of transition and a year of completion of the network, our core infrastructure assets are up. Our network is up almost 90% in terms of revenue around connectivity. And of course, not that's one part of it, and that's a nice stat. More importantly is in the build up to being Indigo being complete in July, we now have the full suite of services to offer. Nick asked a great question. Are customers now buying all of the assets? And the answer is absolutely they are. Now, they're not buying hundreds and hundreds just yet, because you have to put in place the master services agreements, the contractual arrangements, the technical due diligence to allow them to do so. But one of the things that we've got in this network, and this is jumping right to the end, but I might not get to that slide, is we've described this network as fit for cloud. And this, again, was another kind of vision of Bev's way back then, but we kind of crystallized it on this trip, probably over too many mineral waters or rosés in the US, is that what do we really mean by that fit for cloud? And this whole growth in the cloud ecosystem, whereby traditionally the cloud providers were putting massive computational capability at data centers. But as the enterprises connect to that cloud, they need high capacity, reliable, available network infrastructure. So this is where we've coined the phrase, it's not the last mile, it's the first mile. It's the most important piece of connectivity you're going to buy. And then the other thing is reaffirmation of our guidance into FY20 around that growth in that underlying connectivity, underlying platforms, and continue to look for the right area of operational efficiencies as we retire the non-core products and services. I won't take any credit for this slide. This is John's brainchild, and the reason this is the fundamental plan on a page for the company is because all of the data points that flow out of this are a result of this. And this isn't just a pretty slide. This has got a whole bunch of financial machine and spreadsheets behind it. But the idea to say this, let's talk about the assets we've invested in, the assets we've acquired, and the assets we're going to divest. And let's be clear where they sit in the value chain. And let's be clear where they fit together. So that first slide there on the left-hand side is the core Asia-Pacific asset, where it's got the fiber-rich enablement, 25 years of life cycle there, and $256 million invested in it. That's the connectivity growth. And then you see these platforms being the enablement of these services, such as fixed wireless as a supplementary capability, guest broadband or campus capability, home broadband, and of course, CyberHound and security. And it's still a large component of that. $61 million of our revenue is going to come from that business, and that will continue to grow. But at some stage, that will be balanced and outstripped. Well, that's an interesting dynamic. What we'll see there is a different business model than that one. And we've already embraced that with one of our largest campus customers, which is Campus Living. We're changing the business model from an itinerant student paying credit card service for broadband. We'd move that to essentially a price per utility per month for a bed. And that's much better because it's fixed. It's the systems and infrastructures in place that can scale up and scale down depending on how many students are in there. And it therefore becomes a utility charge. It's a bit like your hotel broadband. I don't really look at the bill and see $15 a day of hotel broadband. You just assume that's embedded in the hotel price. We love this slide. This was a combination of the brains and genius of Ryan Crouch, our CTO, and Nick, one of our kind of graphic guys, to say, hey, how can we put all that financial data onto a pictorial representation that doesn't look like complex concentric circles and telco networks and everything else that John loves? And what we're trying to do there is say, look, we build fiber, we dig up the streets, we put them into buildings, we put them into data centers, we put them into campuses. We supplement the fiber with fixed wireless connectivity, point to point and point to multipoint on the rooftops of buildings. That's both supplemented into the building with fiber in the building, and usually as a diversity platform to get out of that building as well. We offer the CyberHound capability embedded into the network at the premise to provide secure internet for schools and education. And more recently, we're now looking at the CyberHound capability into a platform for e-health, which is one of our new verticals we're going into for this year. The guest Wi-Fi is the one we know about. That's traditional authentication capability for broadband security. The difference being there, we've changed the model to a utility-based model. So the costs are predominantly sunk into the infrastructure, and it's a price per month per bed. The residential broadband is just a logical extension of getting traffic onto the network. We already have some broadband subs. We've added to that this year. We're now actually signing up and acquiring NBN broadband subs. So you can click on superloop.com, you can click on your home, and you can say, would you like to be powered by Superloop? And what you're getting, as I said earlier, you're getting a business grade network for your home broadband. And then I would attest it around this room. If you've used it, it really does what it says on the tin. And the final piece of the infrastructure pie is the completion of the Indigo subsea cable system, about 5 years in the making, and a unique asset in the Superloop portfolio, as I said earlier, because we are the only company that connects at all ends of that cable system and beyond. There's other companies that have parts of that cable system. There's other companies that have data center connectivity here. There's other companies that have fiber connectivity in Singapore. But there is nobody that owns construction economics, fiber economics, infrastructure economics at all ends of that subsea infrastructure. There's the operational highlights I mentioned earlier. This is about not only we have transitioned the business in terms of the financial modeling and the reporting structures and the disciplines, we've continued to do the build and operate and fundamentally complete the work that was started. So completion of the network infrastructure, bringing more buildings on net as on a customer demand basis. We continue to get awards for what we do, and that's great. And that's a great recognition for our people who work extremely hard behind the scenes. Massive uplift in traffic on the network since 2016. Massive, almost 2,000%. And there's a further subgraph to that, which I won't show you, but it's a very complicated graph that Ryan shows us on a regular basis that since Indigo turned on, by the way, this has got even worse because you see this uplift of IP traffic coming into the Superloop, connection points and aggregation points. And the great thing about having traffic volume is you can trade your traffic volume. It's a bit like a stock market. You want more volume liquidity to help reduce your flow or increase your flow, reduce your cost. It's exactly the same model in the network. So the more volume we get, the more ability I have to trade on my IP transit means I lower my overall costs. So my consumer broadband, for example, could maybe get X% on a fixed margin basis, but his network utilization drives traffic into my network that helps my buy price. Very similar to the markets. And then the simplicity of the network was to relaunch our product and our product portfolio from multiple products, multiple capabilities, multiple entities across all of the portfolio into on-net products and services that support fiber and fiber connectivity and platforms. And then, of course, that also meant an integration of the teams. And you can see the mass on it, but that's a reduction of about 25% of our workforce as we retired the non-core services. And then each one of these graphs is essentially a subsection of that picture 5, which just breaks down the breakdown of the assets and where the monies have been spent and invested in, where they are in terms of the life cycle, and of course where we start to see this early stages, if you will, of green shoots, with an asset has significant length of time to continue to monitor. Scoot through some of these quickly. I mentioned the 89% year-on-year revenue growth on the connectivity section. You can see it's across all areas. Good to see Hong Kong starting to see some recurring replicable growth revenues. Singapore still seeing some growth, and that was a call out from last year. And of course, Australia seeing connectivity growth. And only now, as on just towards the end of the last quarter, is the pent-up demand of the build of the NBN network. So just to give you a clue, we started at the beginning of the financial year to build and construct a backhaul network infrastructure into the NBN to interconnect the 121 POIs with our own fiber and fiber infrastructure. That means we can offer a service to wholesalers, retailers and consumers and enterprises because we are essentially the NBN friendly partner of choice. It's really interesting if you watch the press in the last month, from everybody having a battle against NBN about it's all, and watch it now, Verizon becoming an NBN partner, Vocus becoming an NBN partner. Everybody's like, guess what? The original NBN partner is here, and we're the only guys that built into the network. The other guys are reselling. We own that backhaul infrastructure into the network. It means our cost dynamics are significantly more attractive. And the interesting piece is that we secured in that, we kind of announced it, but we couldn't because we hadn't fully monetized it. Around about 6 anchor tenants who are going to be the guys who are essentially wholesale retail service providers who are taking our offer to interconnect a nationwide network. 5-year contracts, all of them, fixed price contract other than the use of the traffic where they grow in the network. And that's going to be the underpinning of the recovery of the investments we've made in that NBN backhaul network. And we started to see them billing in Q4. And then just if you look at the platform view of it, this is the revenues that come on the breakdown. You can see the various breakdown there. Essentially, the main platforms are kind of flat year on year, except we have some growth in the consumer broadband. The main reason for that change in the connectivity there of Guest Wi-Fi was because we changed that business model from a consumption-based to a fixed base. The good thing about that is we re-signed the largest customer for 5 years. And since this data was produced, their sites and beds are growing again, which we haven't seen for about 4 years, which is a good sign that not only is the model working, the network is doing what it says, and the new Guest Wi-Fi platform is working. The reason we put this one in is not particularly, I don't like the slides that show things going backwards, but it is a decision that we made that we're going to retire non-core traffic. You can see there at 38% of our percentage revenue spread back in FY17 is now 16%, and that's a decision we made to retire. But of course, what you're doing is replacing that services revenue, computer services, IT services, hardware sales, all the stuff that was not core, hard to support, and actually costly for us. Carried inventory, we carried people, we carried men in a van, we carried all that kind of shit. That's all gone, and we're now focusing on the core. Now, we still have customers in that base that we want to transition them into that section 1. We want a billing relationship on connectivity. So you don't go back to a large customer and switch them off. You transition them to the point where your costs are low enough you can support them, and you find a partner for him to go to. And that's what we've been doing, by the way. We've been establishing relationships with new MSPs, managed service providers, where they say, look, we've got 5 customers here that want their Microsoft 365 in the cloud supported. We don't do that anymore. You do. In return, we would like a slice of your carriage services revenue. I've actually mentioned one of these in the slides. You might not see it in the customer base, but he's quite a strategic partner we're building a relationship with, because these guys are doing lots and lots more of these integration deals, and they require carriage. It's perfect for us because we do the simple plumbing we're good at. They go and do all the hard stuff. You've probably seen many times before the parts of the network, but this is them all on one page. Fibre infrastructure in Hong Kong, fibre infrastructure and duct network in Singapore, the subsea connecting between Sydney, Perth, and Singapore, and of course the 121 points, including Tasmania, for those who are excited about Tasmania. In fact, one of our anchor tenants, by the way, I think I can call them out because the CEO is a friend, is Tasmania. And Tasmania has very, very big ambitions about being a national operator in this network. And they're one of our anchors on the NBN Point network. We met the CEO and the chair a couple of weeks back, and they not only have domestic aspirations, they have some international aspirations as well. So it's kind of funny that little ISP from Tasmania now kind of wants to take on. And they would have never done that without the opportunity to connect into a national network in a cost-effective way. Here's some physical data on the connectivity. As I mentioned earlier, we've 24% up on the buildings to 392. And then the fibre infrastructure, not including Indigo, continues to grow, usually on a build-operate model, usually on a customer-sponsored model, or at least in a success recovery of capital within the term of the contract. And this has been the magic, kind of design of Bevan and the guys, and more recently Alex West and Ryan, is that we're going to build infrastructure. Let's recover the cost of our build and make sure we've got excess inventory with that infrastructure to light up more customers once that infrastructure is complete. This is John's great slide. Nothing like he's stolen out of the MP1 presentation. I couldn't say that on the main call, but we kind of quite like this, and we try to adopt this into the Superloop vision of the spirograph, which really is saying you have to be in it to win it. The more you're connected, the more you're connected. Nothing more, nothing less. But as that spiral gets more and more colored in, it starts to mean that we're closing the ecosystem. And it's a very powerful message when you start to think about it, because when MP1 started to do this 4 years ago, I go, oh my goodness, it looks empty. But if you look at it now, what they're doing is they're starting to close and control the ecosystem. And it was a great I know Bevan's here, but I'll say it because we met in the Western 5 years ago, and he said, what would your vision be for Megaport? I said, we're going to turn it into a verb. If you're not Megaported, you're not connected. It could be the same for us. If you're not Superlooped, you're not connected. If you're not on first mile, not last mile, you're not Superloop. So I'm just stealing some smart ideas from the founder. All right, I'm going to pass it over to the smartest man in the room, to John Tidd.
Not long after the February results, where I think we gave a little bit more insight and information, but probably not as much as we've given in here, a wise investor in Superloop told me a story or a phrase that entrepreneurs and founders can afford to be misunderstood, but the executives they hire can't afford to be misunderstood. And so make sure when you come out with your results, you're giving a bit more information on how to understand the business, how to follow the business, and ultimately how to value the business. Not everybody that invests in Superloop or Megaport or any other organisation is going to get out a spreadsheet and try and model this stuff. But for those that are, give them a little bit more than you have done before. So Nick, hopefully Christmas has come early for you, and in the appendix you can. It's a little bit easier to go through. As Drew mentioned before, I'll come on to the EBITDA variance year on year in a second, but there's really three core questions that we ask ourselves on a daily basis internally, and they're probably the three most common questions that we get from investors as well. The first one is, how are you going monetizing those assets, which is that left-hand column, and hopefully the answer to that is 91% growth year on year on what is on average 2 years old of assets that'll last 89, for 89%. The second question is, what is the value of all of those businesses? For those that have followed the journey for a while, what is the value of those businesses that you've bought, and how do they fit in with the core network piece? And hopefully the answer you can see here is $210 million is the carrying value after taking a $51 million impairment. That's how we and our auditors approach that, obviously not from a trailing EBITDA perspective, from a discounted cash flow perspective. And then the third question is your capital structure fit for purpose? And the reason why I asked that, and Nick, probably to predict a question may come, and I'll probably hand back to Drew and Bevan if the questions get too curly, but the way I see it is, if you split the business into those three columns, we've impaired the far right hand side. We will manage that for cash, and there may be some better ways to offload that. But as Drew said, we want to make sure we handle the customers through the things that we don't want them to buy from us, because we do want to keep having a relationship and we want a strong brand through the end of that. The middle column effectively funds itself, and the middle column is probably your more traditional retail business, if you like, in terms of the debt model and the capital model that comes with it. But that left-hand side is increasingly where our investment, obviously historically, has gone, and increasingly where our investment in the future will go, and where the revenues have come from. And I guess the blunt answer to the question is, your capital structure fit for purpose, one that is applying a trailing EBITDA, whether it's the equity markets or a debt holder, probably isn't fit for purpose on an infrastructure piece. So that's probably as much as I'll touch on that one, other than what we've got in the materials. So to talk a little bit, for those who do still want to see what the trailing 12-month EBITDA was, this is a little bit of a walk forward. The 1, 2, 3 reference down at the bottom is the columns in that previous page. Now, we do still talk about it as connectivity, broadband, and services, and all the material is in that way, but it's an additional way of thinking about our business as what stage in the life cycle are each of the parts of the portfolio in. So this time last year, or in FY18, we had a 9.3 million higher subsea development revenue and margin than we've had in this year. Obviously, Indigo is complete, so we don't expect that to really continue unless something comes up that we certainly don't foresee anything. The flow through of the revenue growth that Drew talked about before is flowing through at a higher margin rate because of that operating leverage starting to pull through. And what I'd probably say in here is, we are still also carrying effectively incremental fixed costs that we call direct costs, that are effectively given us a hell of a lot more capacity and scale by plugging into the NBN. Then the platform category, really fixed wireless, has gone back a little bit from more so on a cost side of things than revenue side of things. And the growth in broadband, both guest Wi-Fi and home broadband. Then the piece that Drew touched on before, that's now about, in our second half, was about 16% of our revenue, but on a full year-on-year perspective, was a 5.6 million decline in services. I don't think there's 5.6 million left to decline in future. We are getting that low, but you can see that in the appendix. As we shared in February, there was a 5.1 million year-on-year OPEX increase in the first half, predominantly from prior year acquisitions. We implemented the first stage of the cost program in February, March, and have seen some of those benefits come through. Obviously, we haven't had a full half or a full year of that, and obviously there were costs that came into that as well. So that's where the 8.5 walks forward from the 22.1 in the first place. I probably won't go into this in detail, but I guess the key point here is across the fibre networks and the platforms and even the services, it's pretty healthy gross margin rates as long as you can get that operating leverage on your fixed cost base. And then the financial position, so cash flows at the top and then balance sheet down at the bottom. I guess the call outs are the investing cash flow lower than the prior year, but in part to do with fewer acquisitions in the prior year and CapEx not too dissimilar, but with Indigo and NBN complete, that core network build that Drew touched on earlier is now complete. There's obviously a little bit of tail into FY20, but certainly not to the same levels. And then from a balance sheet perspective, we talked about the goodwill impairment down below, and therefore effectively this year's cash outflows or use of funds have been 31 million from the equity raise that Morgan's helped us with on back in February, and then 26 million from tapping into the debt facility with ANZ and Westpac. That compares to a 35 million equity raise the prior year and a 33 million debt drawdown in the prior year. Probably leading into the conversation about the capital structure, I guess a visual way of just demonstrating how much we are moving from, let's call it the lighter colours on here being the more kind of retail side of a business where there's not much incremental cost or there's not really much payback from growing and expanding, and it's not, you're not building 20-year assets that have an incredible ROI. More towards the right-hand side where we are almost now at 50%. I suspect August results probably already are up in that level, and so that's the lead in then for the capital structure. I'll just state a few facts on here. So senior bank debt facilities 120 million, net debt at 30th June was 70.3, a gearing ratio of 20.3. Assuming Vocus is using the same calculations, I think they're at 30.5, and probably others in the room that know how we compare to some of the peers around the world. We were compliant at June the 29th, and we've got a waiver in place as we work through with the banks and potential other partners to make sure that we've got a capital structure that aligns to those three columns. We're not necessarily going to carve it out in three different ways, but certainly the way we think about it and the way we talk about it to our debt holders is really the return on investment on each of those parts of our business.